What is going on, you guys, and welcome back to the video. Today's video, we got a general market update for you. This is something that back in the day I used to do a lot.
You should do it every week, right?
I used to do it every single week, and it was, I remember having the green screen up, and yeah, we called it the weekly review. You guys really enjoyed it, but it was quite time consuming to do. But I think infrequently it is still important to look and just look at things like how the markets are performing, right? Year to date, US market, Canadian market. We're going to do an update on the interest rates, which we had some news this week here, especially here in Canada. We're going to take a look at the different sectors and where some pockets of opportunity may be. And then we're going to be finishing off with, I believe, maybe some possible ideas. Trade ideas that we've been kind of thinking about given the information that we covered today. So yeah, I think really that's the topic of today's video. It shouldn't be all too long, but
so just be like where are we? And every once in a while, even though we follow the markets all the time, it's good just to do a snapshot and see where we're at. So that's the goal today.
You lose track. Like, if you're just looking at the markets every single day, you got a feeling of where we are, but you don't, sometimes it's good to kind of zoom out and say, hey, this is where we're at.
When you worked at the firm, we would do a weekly meeting and we'd look at things like the indices and where we're at, just looking basically for opportunities. And so that's kind of what we're going for today, different versions.
For sure. Yeah. Well, hey, let's kick things off. Let's start with the broad, just how are the indices doing? And up on the screen, basically we have a few different performance metrics, basically looking at the NASDAQ, the S&P, and then the TSX. And just to highlight these, we do see the NASDAQ on a year-to-date basis being the best performer, actually posting a positive gain of 8.21%. And this is filming as of, by the way, what is it today? It's the March
the 11th.
March the 11th. So yeah, Saturday. So hopefully you guys are seeing this early in the week next week. But nevertheless, 8% gain on the NASDAQ year-to-date. The S&P is essentially flat, down at 0.58%, and the TSX a nudge above flat. But hey, positive nonetheless at 2%.
Interesting with the year to date, it's been very volatile, as probably a lot of people have known, and I think that's caused by a lot of uncertainty. I think we're going to talk briefly about the collapse of the Silicon Valley Bank as well, and that kind of says to me there's just so much news out there. Everybody wants the good news, and we're seeing pops where the market's going well. We've seen a bit of a retracement there.
Well, even just like, I feel like 2 weeks ago, maybe, what is it? 2 weeks ago, just 3 weeks ago, maybe it was. I mean, markets were up much higher than they are today, and we are just starting to see that come back down. And the
last video I did on the 17th of February, which is in my Have We Reached the Market Bottom series I've been doing, markets were looking good, and it was like maybe we're through the worst of it. Well, here we are. If we stretch this line out just to 1 year and kind of get a little bit more context, we can see if we look over that time, the major markets are still down over that 1 year time period. We got the S&P with the best returning of the best of the worst. Yeah. So negative 8%. But if we look at, for example, the NASDAQ there, I mean, it's down at almost 14% 1 year. And then since the market topped, so I'm just going actually back to January 1st of 2022, when we saw the slide start, you can see there, we're still quite a bit into negative territory across all the indices. So,
especially the NASDAQ there, down 26%. Yeah.
Yeah.
Yeah, well, no, I think it's nice to kind of get a feel. I know everyone uses different, they benchmark to different things. A lot of tech investors look at the NASDAQ. I personally look at the S&P and TSX. My portfolio is primarily
more geared there.
But nevertheless, good to know where we are. This is one that I really like looking at, Dad, and these are the various sectors. Basically, we've kind of screened these by, first one I believe is a year-to-date number. Yep, absolutely. And we have the S&P 500. And why I think these charts become valuable is, not always, but they can be good indications of potential pockets of opportunity. Areas that are maybe overheated and hot. Yeah. Also areas that are underloved. If you do believe in this reversion to the mean, I think this is something that from time to time I'll look at to just start my start my research on this particular area.
Well, this is something that we always did. We looked at areas that were the sectors that have been hit hardest, maybe offering opportunities. Yeah. And like you say, if they in a hot sector year to date, maybe time to take a little bit of money off the table. And I think we're going to see that as we go through these numbers here today. A little bit of that. So
yeah. So year to date, here's the S&P. We do see the best performing sector is tech. Now again, if we look over a 1 year number, which we we'll see this come down, but since January of this year, the first couple months, tech has been the top performer, up about 8.97% as a sector. Communication services as well is doing well. On the downside, we have utilities. And again, these are American utilities, the S&P utility companies. But yeah, healthcare and utilities are the laggards on a year-to-date number, down about 8 and 9% apiece.
Now, if we flip that, Brandon, to a 1-year number, so if we stretch that line out, so you just mentioned, for example, IT and communication services, the hottest sector so far this year.
Yeah.
Look at last year. You see IT sort of in the middle of -8% last year, but look at communications down 23%. And this is not something this is not unusual. That's kind of what you'd expect to see, that the cyclical nature of all of these types of businesses, right? When we look at Canada, we see kind of the same. We see right now the 2023 year to date, IT leading sector, 12, almost 13%. Real estate up there, just over 5, and consumer staples the worst performing. But when we look at the Canadian indices versus the U.S., we're looking pretty good actually. It's much more stable, interestingly. But if we look again at the 1-year number, we look at the leader being energy at 10% up, and you'll notice that was one of the worst performing last, over the 1-year time period, and then the worst performing by far this year so far, or over the 1 year rather, has healthcare at 47%, materials down 18%, and just like in the U.S., we've got utilities being hit pretty hard, down 15%. Year to date.
I will call out real estate as well there. I mean, real estate was one that I've been eyeing, and I did a video, I believe it was last week, on a couple stocks that I like at the moment, and I think Realty Income was one of them. We can touch on that later towards the end, but again, these are just like starting points for potential pockets of opportunity. Again, the year-to-date charts that we looked at today, they're great, but I actually prefer to look at like a 1-year rolling number. That's to me richer data. Like I said,
especially if we're just over 2 months into the
year. It's just not that much. It's still good to know how over the short term they've been performing, but to me, what jumps out here in the Canadian market: utilities, materials, real estate down 15%, healthcare. Cannabis stocks are obviously in the healthcare. They get categorized there here in Canada, by the way.
Yeah, because they're healthy.
Yeah.
So another key driver of everything these days, of course, is interest rates, and that's been the big story. Let's look first at the Canadian markets. And if we look here, just a few days ago, so on March the 8th was the most recent announcement, and good news,
hallelujah,
probably, that the central bank, the Bank of Canada, decided that it would leave rates unchanged. Now, they're still at 4.5, so they're historically, that's not that high, but in the last decade plus, those look pretty high.
I spent a lot of time there doing reading commentary online, the difference of opinions, and what I came away with was, I think there was an expectation amongst Canadians that, hey, there's a good chance that the rate doesn't get changed, it stays the same, but there's still very well, it may be room to go. And what a lot of people were saying online, at least, is it's almost like, obviously you'll see in a second, the Fed has continued and mentioned that they're going to continue raising rates. Yeah. And I think, it's like that, do you just rip off the Band-Aid and just do it versus kind of prolong it?
Yeah.
That was kind of the gist that some people were speaking about.
Well, look at the markets last week. We saw the Bank of Canada hold rates steady at 4.5%. But the markets basically tanked. I mean, everything was down last week, it seems. So let's look at this quick table here, just as a refresher over the last year. The non-raise, I guess, this past Wednesday was the first time in a year that the Bank of Canada had not raised, and we can see a pretty significant increase from 0.25 back January last year, and a year ago 0.5 all the way up to 4.5%. So that's a steep,
very steep
incline there. The rest of the year, we have more rates coming up. The next one will be not that far from now, April the 12th. And what I'm looking forward to here is not only will there be the interest rate announcement, but there's going to be the monetary policy report. And you can go as deep as you want into the weeds in those reports, but it does give you more depth. As far as the U.S. goes, they're basically similar, but they've raised the rates up to 4.75. So there's not a huge difference between Canada and the U.S., and that's typically what we see.
Yeah, and in their most recent announcement, they did tick them up. So they haven't actually stopped like Canada.
Let's throw this chart up on the screen here, Brandon, that shows what we just looked at. So that we're showing the increase. The orange line is that Fed rate going up. But the blue bar is a percentage of increase for each subsequent increase. And so we can see, back in May of last year, it was a 100% increase, right? And that degree of increase has gone down and down in the coming months. And so that's I think it's positive, but like you kind of just alluded to, the money really is on more, and Powell just spoke last week, and the implications were that they're going to go higher. And you can see here, again, a little bit of history going back to the latter part of last year, and then you can see the upcoming announcements as we're going forward. So lots of interesting stuff to come, I would say. It'd be lovely if by the end of the year we have that a bit of stability where we can count on some, at least level, or starting to come back to what we've seen more recently as normal rates.
That's what I'd hope for. I mean, when you say more recently, like you don't anticipate rates coming back down to where they were, and so close to zero.
Well,
you mean lower? You mean what do you mean by as of recently? Yeah.
I'm not predicting that. However, if we do go into what a lot of people are saying is a pretty strong recession coming, I mean, it's nice that they've got the interest rates where they are, so they can ratchet those back down. Because if you're starting at 0.5 and you want to use interest rates to help the economy while you're starting from too low of a point at that point. So, one thing...
Well, we can talk about that. I mean, recession, I think we had as a topic here. Maybe very briefly we can touch on just the markets. And clearly, as you've mentioned, the markets have been moving quite a bit. Up and down to the start of the year. A lot of it depended on stuff like these interest rate announcements. But one of the charts we have here is basically just a broad PE ratio. If we were to just look at the broad market, and I'll anticipate this is the S&P.
This is the Schiller S&P, yeah.
Exactly. So if we're just looking at the broad market, it is coming down as the markets have come down. But, even... it's if we still looked at a long-term average or a long-term mean here.
What jumps out at me, a few years ago, it was trading at the highest it had been, right? And I remember doing some videos there and just saying, like, this is getting into dangerous territory.
Yeah.
And we've seen that come down, gyrate a little bit. But you're right, 28 right now for that, the current rate. And if you look back over history, the last time we saw that was, Black Tuesday, and I don't remember that. That was before I was born, before everybody watching this practically was born, but, back in the dirty 30s. And then more recently, when we look back to even 87, Black Monday, you see where that the S&P or the PE ratio was then, significantly lower than today. And the last time we saw it sort of around this level was just back around 2000, and of course the world was disrupted then. So
I think that's one of our takeaways, which we can kind of get towards the, when we do talk about the areas of opportunity, like although the market is down, I don't like seeing people saying, oh, cheap, buying opportunity. Hey, very well could be buying opportunity, and in pockets, but it's that misconception that a lot of newer investors have, that just because things are down, that there's no more there's no more drops to go.
I would caution against the I'm so happy the markets are down another 5% because I can buy more. No, yes, if you are a dollar cost average investor and every week or every month you're committing money to the markets, I agree. Just let it ride. Assuming you own good quality assets.
Yeah.
But I think, like you say, there is a bit of a misconception that we could have a long way to go. And if you're a newer investor, you may not have gone through a period of time where you really, that real gut check.
Yeah.
And so just be cautious with that strategy and make sure that when you're just, buying more, you're buying the right assets. Right?
Yeah. We haven't had this discussion yet, Dad. I mean, you just got into town. Although we do talk virtually sometimes. I was having some discussions with some of my other peers about, the severity of this potential recession, if there is one coming. And, I haven't ever I've lived through, a previous recession, but not to the point where I cared about it.
Yeah.
I am under the gut feeling, and I've been saying this for quite some time, like even if you go back before, right after COVID, I believe that we could still have a pretty severe recession that just prolongs, and that's something that we have to live with.
Yeah.
In other words, I don't think that we're out of the woods quite yet. I know you probably have more opinions on that, but what I mean by that is, I'm sure throughout, if you go look back through history, you have more severe recessions, more shorter ones.
Absolutely.
Little ebbs and flows. I don't think it's, and again, this is just my gut feeling. I don't think it's right to think that we are out of the woods now that markets have just started to pick back up. In fact, I think recession-wise, like what I'm hunkering down for on the business side, on the personal side, is really 1-2 potential years of trouble, if you will, in the economic side. Which again, where the stock market plays via that, yet to be seen. But that's kind of my anticipation since day one of COVID. Like, this is gonna come back to get us.
I believe that there is more pain to come. whether it's that hard landing that we're kind of referring to, or whether it's a softer landing and more prolonged, only time will tell. That's one thing I've learned from either being through them or studying recessions is you really don't know.
Yeah.
And there's all kinds of predictions from really, really bright minds out there with teams of analysts who are trying to nail it, and they don't. Only in time will we know, right? Some recent headlines, we've been looking at here. You're looking at CNBC. Recently just said there's no exit ramp for Fed's Powell until he creates a recession. So being proactive that way. BNN, Canada will come to a recession early in 2023. While we're early in 2023 right now.
2023.
The Economist, this is an article I read, why a global recession is inevitable in 2023. I think this is kind of what you were alluding to. Be prepared. And if we avoid it, whether it's soft or hard, awesome. You're going to have money. We don't advocate for anybody sort of sitting back and keeping your money all in cash, waiting for that to be over, because we never know. We just crossed over. March 9th always sticks in my head, because at the end of the credit crisis, it was March 9th, 2009, when that bottom was found. Of course, we didn't know that for sure until sometime later. And there was it's kind of reminds me of now where a lot of people are, we're done. We've seen the bottom for sure. Other people are just wait, there's more to come. So we don't know. One thing that does sort of concern me a little bit, and it's a reminder of that time period, is with the Silicon Valley Bank implosion. I mean, 48 hours ago, it was a going concern. Concerns me a little bit. That said, as always, you got to be prepared. It's one of those things where if you have a portfolio built properly to meet your needs, you'll weather the storm. But you kind of have to be prepared for that. So don't go in blind.
Fair. Well, hey, this video's already, it looks like, going along. So why don't we just finish off with some ideas that we've had personally?
I'll start with one, because I know we talked. Well, you mentioned, because this past week I had bought some additional high yield fixed income in our portfolio that we have on the Blossom app. And my logic is this: if we look at high yield bonds, fixed income, typically you're going to get a U.S. bond as a Canadian person here, and the yields now are sort of in that 5.5%, 6% range. So not bad, but there's this perception out there that bonds are all kind of the same, and bonds are so different. Just like the sectors we looked at earlier in the S&P 500, how they go up and down, bonds have different types of bonds have different characteristics as well. One of the characteristics that has sort of proven over time is that a high-yield bond portfolio will absolutely decline in value when the equity markets go, but a percentage of it. Equity goes down 10, fixed income might go down 5 or 6, somewhere in that range. Goes down 20, might go down 10. There's downside, and we certainly saw that over the last year and a half. But on the upside, once the market has actually turned, there's a very close correlation of the bonds. So if you're going to have fixed income in your portfolio in these sort of uncertain times right now, I'm leaning more personally to the high yield, because you have less downside, that risk, than you would in an equity portfolio, but you have a pretty good recovery along the way. So it's kind of hedging your bet a little bit, not being fooled and thinking, bonds are safe.
For sure. And I think I think the bond that we ended up bidding was offering a 6% yield, which is quite attractive, like you said, in comparison. A couple ideas on my end. I mentioned looking at those sectors, just some possible areas, and I know real estate was one of them that jumped out to me. Obviously, I'm just reiterating what I said in that previous video, but Realty Income was a stock I added to my RRSP just for my long-term retirement. And if you didn't catch that last video, I would encourage you to go back. I did a short video, so I'm not going through a whole bunch of stuff, but we looked at some key highlights, how long they've been paying distributions, how long this is a REIT, by the way, Real Estate Investment Trust. Actually, the first REIT that we've purchased REITs in our corporate account together, but in my personal RSP, first one I bought, and it was
Congratulations.
I'm getting in the real estate game, if you will. But as you know, I have enough real estate exposure elsewhere outside of my stock portfolio, hence why I thought, why double up? I have actual physical real estate exposure. That said, I just really liked this opportunity, and I think Realty Income is one of the top tier REITs out there. It is American. Again, I think that's actually quite suitable for my RSP, but that I think is a definite one to look at. Great yield and great sustainability. I think what I've personally been looking at with this collapse of the Silicon Valley Bank, on Blossom, for example, I was on there. I'm on there every day. But last week, like Friday, whatever it was when it happened, everyone's buying the dip on TD, BMO, taking advantage of the Canadian banks that saw a big dip because I mean that there was a ripple effect, absolutely.
Totally, yeah.
And I'll say this, I didn't immediately pull the trigger because what you said there, Dad, about the potential forecomings and potential domino effects. I mean, hey, I haven't taken the time to look at how much. I mean, I've watched a number of videos and done a bit of reading on the Silicon Valley Bank, and it is truly fascinating how many companies are actually exposed to this, and especially the tech and healthcare companies. It's wild, really. I don't know how that translates over to the Canadian banks, right? And again, I don't want to jump the gun and say, well, we're in the clear. If I had to lean one way, I'd want to hope that we are. I think, we speak about it time and time again, that Canada has these premier banks in the world, and that they are, even if you look at, one of the things we look at, even when we're looking between TD, Royal Bank, BMO, is, for example, their exposure to, the real estate market or mortgages, for example.
Different sectors.
Different sectors, like where their exposure is. And just from the top of my mind, it's very different than the Silicon Valley Bank, which is loading onto all these crypto, all these startups and projects of that sort. Again, I like to think of them as different class, but I also don't want to overspeak and say, well, you're clear to go buy these. I want to do my own research and due diligence. So over the coming week, I very well may add to my TDs or my Royal Bank position, which I already thought were trading at a fair price prior to this. I thought a very fair ad at this point, but this may even be more of an opportunity to say, hey, if the market wants to bring them down, if that fear is there, certainly an area that I will be doing my research on in the upcoming week.
And just to drive home that point, the fact that a sector or a company has dipped doesn't mean you run out and buy it.
Not right away. Yeah.
Often, if you're looking, like say, use Canadian banks, most likely you're going to be fine, buy them lower, but so that's probably not the best example because they are so stable. But just really.
But I'll say this:
I always kind of take a breath and go, let's look at the actual reasons, what the repercussions, and then maybe an opportunity, but make sure you're firm in that decision.
I think that's the caveat in this unique situation. If the Dow is down, 500 points or whatever, and the markets are just broadly down, sure, take advantage by the dip. If there's just some general stuff. But this is a very particular case with potential tied ramifications. Whether they're tied or not, it's the same, it's the banking sector, and there's going to be a lot of stuff that comes out of it. So in this case, it's one of those where, hey, maybe you do have to take a couple weeks and do your own research, not just blindly buy.
And as we've seen by the charts we showed earlier, you don't have to do anything today. The markets move in those cycles sometimes pretty quickly, but a few days is not going to change that. It also does remind me of when, in 2007, 2008, things happened that people were, where did this come from? We had no idea. And I'll bet you a lot of people, myself included, I mean, I've never looked at the Silicon Valley Bank as an investment, but how sector focused they are and how the business was run, okay, it makes sense now, but a lot of people are just putting their money in. And so a really good lesson.
It's easy to say in hindsight. Funny story on that bank, just to wrap things up. I was watching Daniel Pronk, other YouTuber buddy. They did a live stream, and they were reached out to by the Silicon Valley Bank. They're trying to solicit their money a year ago or so.
Oh, well.
Saying, come bank with us, offering these good rates. Chatting with Max this morning. Max had meetings with the Silicon Valley Bank for Blossom. They were pretty aggressively. They were pretty aggressively pursuing, and really, it's just marketing. They're trying to grow their bank at the end of the day. And luckily, Max as well said no. But then this goes back to 2022 when things were a different landscape. But it's fascinating. But what Daniel was saying in that other video was the rates sounded too good to be true, and it sounded a little bit. He had a bit of red flags, and it's easy to say in hindsight, looking back, oh well, this is all the mistakes. But in the moment, like you said, a lot of these times when there is a huge market crash, it's not till later that you realize, oh yeah, we were probably doing something wrong. We don't know until later.
We like to kind of turn a blind eye to these awesome opportunities and not really do our due diligence properly on them, and they do come back to bite us from time to time. So.
But good on Daniel and Max as well for hinting that, hey, this sounds a little too good to be true. There is some red flags opting not to do it, and again, in hindsight, it worked out well. To me, it's funny. There's a lot going on in the news, and there's a lot going on in the markets. It doesn't. I'm unfazed. I've mentioned that before, and I'm unfazed because I understand how investing works over a long period of time, and I'm not expecting that every single year you post a positive return. There are certainly months, years, and sometimes even back-to-back years or a real swell of periods where your portfolio performs in the red. And that could be from poor stock picks, and I have my share of underperforming stocks, but it also has to do with just the nature of being an investor. And there are going to be years. I mean, we looked at it on a 1 year number. What is it? The Nasdaq's down 26%. The S&P's down 17% on a 1 year number. That doesn't concern me that the portfolio is down, because I know that over a long enough time, as long as I'm building it properly, as long as I'm consistently adding money to the right areas, to the right stocks, I know that when I look over a 30-year time period, this is going to be a flash of red relative to my other green years. And again, it's not doing anything rash, not doing anything crazy. It's just, I always like to say, you take that really long-term approach, which I have the luxury of having. It doesn't faze me. Just
what that reminds me, what you just said, I'm going to try and put that into a nutshell, is everybody know yourself as an investor. Like what Brandon does is not necessarily what you should do, and what I do isn't what you should do, etc. Know who you are, have the battle plan, right? And really, I mean, literally have it written down where in times like this, here's my plan, right? And then, of course, you reassess as you get older, but that's critical in times like this. So I'm very, I don't know if excited is the right word, but I'm looking forward to the coming weeks and months, because, like I say, there's going to be a lot of action out there, I believe. And for someone like you, who I feel very comfortable in the space, I'm more curious to see where it's going to go. And then there'll be another time, and 10 years you'll look back and go, I remember that. Because to me now, I can't believe that the credit crisis was going on now more than 15 years. And I vividly remember those days. I hope we don't see that again right now for a lot of reasons. But if we do, we do.
Hey,
we're on the boat, so we'll hit the waves, I guess.
You mentioned so many things throughout this video, Dad, like having a plan and literally having it written down, concrete, an IPS. These are the types of things that we do with our students to make sure that during periods of times like this, well, hey, we have been prepared. We have been proactive. And it doesn't stop the bleeding in the portfolios, but you handle yourself different as an investor when you understand yourself. And when you truly have a portfolio that suits your needs and goals as an investor. So that's just one of the many things you would learn at the Investing Academy. There's a link down below, as always, to check it out. We have a variety of programs on there, all included, and for beginners, more intermediate, everything. Like there's a lot of stuff. So have a look. We'd love to chat with you if that is the case, if you're looking to join our community there. That is that first link down below. But as always, I think we can wrap up.
I think so. It's been a joy. Thank you, Brandon, for having me here.
You're welcome.
In the city, and I guess we will see you in the next video.